What are the components of a profit and loss statement? There's a lot to keep in mind to get your business started at full speed. As an entrepreneur, you need to maintain a strong profit and loss statement so your plans don't backfire. The P&L statement, balance sheet, and cash flow statement help evaluate the performance of your company and identify areas for development. In our previous video, we defined a profit and loss statement and why you need to keep your books in check to determine growth in the upcoming month, quarter, or year. A profit and loss statement is made up of a lot of different components that come together to help you determine if your company is lucrative and sustainable in the long term. So let's take off. Just as a car transmission can be manual or automatic, there are two methods you always take into account. The first method is called the cash accounting method, a fairly straightforward system that tracks money that has been paid or received. The second mode is called the accrual method, which is a bit more complex. However, this complexity only serves to increase your performance and make you go faster. Daily updates help calculate the company's current and future finances and constantly adjust cash flow in the long term and short term. Now that you've determined your transmission, how do you make the car move? Well, the key is how to categorize the profit and loss statement. The engine of your business is determined by your revenue. On the other hand, the brakes that help control your business's momentum are the expenditure. Together, these two push and pull to maintain steady speeds, especially on sharp turns. Your revenue is generated based on all the sales transactions completed, while your expenditure includes rent or lease fees, payroll, office equipment, insurance, taxes, depreciation, marketing, etc. The more precise you are, the more you can manage it like a well-oiled machine. Think of the cost of goods sold, also known as direct costs, as your chassis. The body of your business, it involves all the raw materials needed to create your product and services. It's important to note that values like labor, marketing, insurance, rent, and accounting are not a part of direct costs. The difference between your income and direct costs is your gross profit, the axle and differential that keep the car balanced on the road. Gross profit equals revenue minus direct costs. It demonstrates the company's profit through the sale of its products and services. A tricky part of any business is the unexpected obstacles, but just like a GPS, operating expenses help navigate your way through the unexpected. Depreciation is the gauge that depicts the wear and tear of an asset, like a piece of machinery or equipment. To make sure you can jumpstart your profits despite taxes and interest, you need to break down the earnings before interest and taxes, EBIT, including all incomes and expenses. If you're operating without interest, then you calculate your earnings before taxes, EBT, allowing you to speed through every aspect of your expenses by the end of the fiscal year. We're almost at the finish line, but we need to find out what our net income is. To do that, you take your revenue, then subtract from it the cost of goods sold, as well as all direct and indirect costs. There you have it, your net profit or net loss. The reason you started a profit and loss statement. If you want to go the distance with your business, you need to plan every kilometer ahead. The profit and loss statement ensures that your journey won't have any financial obstacles. Stay tuned for our next video, where we explore how you can utilize your profit and loss statement to optimize company finances.